Today's housing market update brings a mix of troubling numbers and unexpected behavior. Foreclosures are rising. The economy is clearly losing steam. Affordability is sitting at the worst levels we've seen in modern history. Yet somehow, home prices keep climbing. On the surface, that makes absolutely no sense. But once you dig into the data, the picture becomes a lot clearer. And that's exactly what we're going to do right now. So here's the situation. Homeowners are feeling the pressure. New foreclosures are up 20% compared to last year. That's 8 months in a row of increases. Now, before anyone jumps to the conclusion that a 2008-style crash is underway, we need to really understand what those numbers mean. Yes, foreclosures are rising. No, that does not automatically guarantee a collapse. What it does show us is rising stress in the system. The natural questions are, should we be worried? And is any of this actually affecting home prices? Let's start there. The median sale price of a home in the United States is now roughly $440,387, which is actually 1.4% higher than it was a year ago. So even with foreclosures ticking up, they haven't increased enough to make a dent in pricing. And there is a very specific reason for that. If you look at foreclosure data over the past 2 decades, quarter by quarter, you can actually see the 2000s crash forming in slow motion. Back then, the curve was bending upward dramatically. Foreclosures were piling up with a steep slope that warned everyone, if they were paying attention, what was coming. Compare that to today. The slope now is barely a slope at all. It's there, but nothing like the runaway acceleration we saw before the crash. And that's key. Those headlines about a 20% increase? Yes, they sound scary, but context matters. A 20% jump from a small baseline is still a small number. And when we compare today's foreclosure levels to the last housing crisis, the difference is almost absurd. Right now, only about 0.5% of mortgages are in foreclosure. That's actually lower than the historic average, which sits around 1.5%. During the last crash, nearly 4% of all mortgages were in foreclosure. Completely different world. Let's zoom in at the state level. Foreclosures per housing unit are currently highest in Florida, which holds the #1 spot. South Carolina follows in second, with Illinois in third. They're followed by Delaware, Nevada, Ohio, Iowa, Maryland, Utah, and California. When you overlay that with price data, you can see exactly how location determines everything. Nationally, prices are up 1.4%. But that's simply the average of many wildly different markets. On the map, yellow shows falling home prices. Red shows deep declines. Blue indicates rising prices, and darker blue means strong growth. Florida, the state leading the chart in foreclosure activity, barely shows any blue at all. If you zoom in, yes, you'll find a few counties holding steady or slightly increasing. But the overall picture is weak. And honestly, it makes sense. Florida is getting hit by a perfect storm. Soaring insurance premiums, an oversupply of investor-owned properties, and a flood of pandemic-era buyers who bid prices up aggressively. That pressure is finally catching up. But then take a look at the Midwest, the Northeast, and much of the North in general. Most of those areas are up, even if only modestly. Combine that with strength in several western metros, and the national median ends up slightly higher than last year. But you have to remember this. A 1% increase is nothing compared to what a crash actually looks like. During the last housing market collapse, national home prices fell more than 30%. Right now, they're not just holding, they're rising. Which brings up another important question. If the economy feels weak, mortgage rates are high, prices are high, and people are clearly under financial pressure, why aren't foreclosures skyrocketing? The answer lies in interest rates and equity. Most homeowners are locked into incredibly low mortgage rates. 20% of mortgage holders have rates below 3%. 32% are between 3 and 4%. And 72% are at 5% or below. So even though we're seeing more mortgages above 6% enter the market, the majority of households are sitting comfortably with cheap debt. When your monthly payment is based on a 2 or 3% interest rate, it becomes much easier to keep paying, especially compared to someone paying 7 or 8% today. So, could we see price corrections? Yes. Could certain regions struggle far more than others? Absolutely. But a full-blown nationwide crash in 2026? Data doesn't support that view right now. Let me know what you think in the comments. Make sure you're subscribed so I can keep you updated as this situation continues to evolve. Thank you for watching, and I hope you have a great day.